Welcome to this explainer. Okay, let's dive right into this, because today we're going on a bit of a comic book style journey. We're going to uncover exactly how insurance companies act as these, financial heroes, quietly working behind the scenes to protect us from the very real villains of uncertainty and risk. I mean, from the outside, it might seem like just a boring bunch of paperwork, right? But the actual mechanics of insurance are a fascinating, highly tuned defense system against the unpredictable.
So, here is our issue index for today. We're going to start with the power of insurance, meet our villains, selection and hazard, explore the heroes of life insurance and the defenders of property, unmask the financials, and finally, look at winning the KPI battle.
All right, Chapter 1, The Power of Insurance. Every great hero needs an origin story, right? And for insurance, that origin is a legal contract.
Think of this as the sacred oath of the insurance world. Based on Article 1882 of the Civil Code, the core concept here is basically a swap. You're swapping a known, manageable cost, which we call the premium, for a rock-solid promise of future protection against an unknown, potentially devastating loss. It's a contract of compensation, or, in the case of life events, a promised capital sum.
Let's bring this down to earth with a real-world scenario so we can really understand the roles in this contract. Picture Gianni, a businessman from Bergamo. He decides to take out a whole life policy, paying a regular premium. And the goal, to guarantee a lump sum is paid to his son, Giovanni, upon Gianni's passing. It's a classic, straightforward setup.
But let's actually test your understanding of the mechanics here. Pop quiz time. Based on Gianni's story, can you identify the three distinct roles in an insurance contract? Like who is the policyholder, who is the insured, and who is the beneficiary? Take just a second to lock your answers in.
All right, let's see how you did. The policyholder is Gianni. He is the one who actually signs the contract and pays the premium. The insured is also Gianni because his life is the one being covered by the policy. And the beneficiary, the person who actually receives the cash when the event happens, is his son Giovanni. So in this specific case, Gianni wears two hats.
But hey, it doesn't always have to be that simple. And this brilliantly illustrates just how flexible our hero's contract can be. Meet Enrico. He's a lawyer who wants to provide for his nephew, Filippo. Enrico buys the policy and pays for it, but he's too old to get a good rate. So what does he do? He insures the life of his younger sister, Enrica. Look at how these roles split up now. The policyholder is Enrico, the insured is Enrica, and the beneficiary is Filippo. That's three completely different people forming one unified shield of protection.
Chapter 2, Villains, Selection and Hazard. Because our financial heroes constantly have to battle the twin villains of asymmetric information.
Now, asymmetric information basically just means one side of the contract knows more than the other. Usually, it's the customer who knows way more about their own personal risks than the insurance company ever could. First up, we have adverse selection. This villain strikes before the policy's even bought. It's that tricky problem where the people most likely to suffer a loss are the exact ones knocking down the door to buy insurance. If an insurer isn't careful, they end up only covering super high-risk individuals. Then we have moral hazard. This villain attacks after the coverage starts. It happens when someone takes less care to avoid a loss simply because they know they have an insurance safety net. I mean, think about someone leaving their car unlocked on a busy street just because they know they have great theft insurance.
But don't worry, our heroes aren't defenseless. To defeat adverse selection, life and health insurers might require physical exams, or they might exclude pre-existing conditions entirely to ensure they aren't taking on a guaranteed loss. And to defeat moral hazard, they use deductibles and co-insurance. A deductible basically means you pay the first, say, $500 of a loss yourself. Co-insurance means you split the percentage of the overall cost. Both of these tools ensure you have some real skin in the game, which magically encourages you to be careful even when you are totally covered. Moving right along to Chapter 3, Heroes of Life Insurance. Let's look closer at this specific division, whose main mission is to protect against premature death, illness, and the income loss that comes with retirement.
I kind of like to call this the multiverse of ordinary life insurance. Notice how these four main types fundamentally differ based on two key questions. Does the contract expire, and is there a savings element? Term life is pure, simple protection. It expires, and there's absolutely no savings. If you outlive the term, it pays nothing. Whole life, however, has no expiration date, and it actually builds a cash value you can borrow against later. Endowment life eventually pays out its face value to you if you survive the term, acting as a great savings mechanism. And finally, variable and universal life policies invest your premiums into mutual funds, meaning your ultimate payout can go up or down based on market returns.
But who actually makes all this possible? Meet the true mastermind behind the scenes, the actuary.
This is the mathematical genius who analyzes mortality rates, produces life tables, and applies complex time value of money concepts. By calculating the exact probabilities of life and death across huge groups of people, actuaries allow insurers to pool individual risks together. This diversification, that is their superpower. It's literally what makes the premiums affordable for you and me.
All right, Chapter 4, Defenders of Property. Let's shift focus to the property and casualty heroes, often called PNC, who defend our physical assets and our legal standing.
Property insurance is basically all about your stuff. It protects businesses and homeowners against losses to their physical assets, things like a fire, a lightning strike, or theft. Casualty insurance, on the other hand, which is often known as liability insurance, is entirely different. It doesn't protect your stuff, it protects your wallet from other people. If you are ever found legally liable for negligence, like causing an auto accident that injures someone else, liability insurance steps in to prevent your complete financial ruin.
Chapter 5, Unmasking the Financials. Let's peek behind the cape and see the structural base of an insurance company. How do they actually manage all this money?
Imagine a simplified balance sheet of a life insurance company that has 355 million euros in total liabilities and equity. The absolute biggest chunk of that is a category called technical reserves, sitting at a massive 195 million euros. So what are technical reserves? They are the mathematically calculated funds set aside right now to pay for the future claims they have promised. It is quite literally the physical manifestation of their promises. For an insurer, their biggest debt by far is the money they fully expect to pay back out to their policyholders.
And that brings us to the stuff that keeps these companies up at night: underwriting risk triggers. See, an insurer collects premiums and invests them to pay future claims. But underwriting risk happens when those premiums suddenly aren't enough. Why would that happen? Well, three main reasons. One, an unexpected increase in loss rates, like maybe a massive natural disaster causes way more property damage than anyone predicted. Two, an unexpected increase in the company's own operating expenses. Or three, an unexpected decrease in investment yields, meaning the money they invested in the stock or bond market just didn't grow as fast as the actuaries calculated it would.
Chapter 6, Winning the KPI Battle. So how do we actually know if our heroes are winning or losing? We look at their key performance indicators.
For property and casualty insurers, it all essentially boils down to two main ratios. First is the loss ratio. This is the total claims they had to pay out, divided by the premiums they earned. It tells us exactly what percentage of the premium money went directly back out the door to help people. Second is the expense ratio. This is their operating and administrative expenses divided by those same earned premiums. It tells us how much money it costs just to keep the lights on and run the insurance business, paying staff, agent commissions, and adjusting claims.
And this brilliantly leads us to the single most important number in the entire insurance world: less than 100%. If you take the loss ratio and add it to the expense ratio, you get what's called the combined ratio. If that combined number is under 100%, the insurer has achieved ultimate victory. It means that the premiums alone were more than enough to cover both the claims and the running expenses. They made an underwriting profit before they even counted a single dime of money they made from their investments.
Now, life insurers, they use slightly different metrics to track their success. They look at the technical margin, which is essentially the overall profitability of their core insurance activities, so premiums and investment income minus the benefits paid out and reserve changes. They also watch their persistence rate super closely. This measures customer retention. Because life insurance is such a long-term game, keeping customers happily paying premiums year after year is absolutely vital for their stability. And finally, they monitor their mathematical reserve ratio to ensure they always have that long-term safety net completely funded and ready to go for decades down the line.
We've seen how they battle moral hazard, how they mathematically pool our risks, and how they secure their balance sheets to keep their promises. But I want to leave you with this final provocative thought. If risk and uncertainty are always evolving, think about modern cyber threats or the impacts of climate change, how will the insurance heroes of tomorrow adapt their superpowers to continue protecting us? It's a fascinating question, and one that absolutely proves the world of finance is never, ever standing still. Thanks for joining me on this explainer, and keep learning.